I just referenced Apple as being one of the stocks that people are looking at as a bellwether for the overall market. Is it fair to say that your clients and the people that you talk to are paying close attention to Apple and that big technology trade?
Yes, it is. And good morning, Dom. Apple has traditionally been one of, if not the largest holdings of the individual stocks of our members. But, the biggest thing that happens in our groups when members get together all around the world every month is they say, if a stock has gone down, should you get rid of it or buy more? And if you don't know the answer, you shouldn't be in the stock. For most of our members who hold Apple, they have a long-term belief that it's just going to keep on going. It has so many unique advantages as opposed to, let's say, Tesla right now, which not only has problems with its CEO, but competition coming on strong, the likes of which it's never seen.
Michael, what is the conversation like around Tesla? First of all, I should point out, Apple's market cap, we've shed almost north of $900 billion in market cap for Apple. It's been a huge market cap shaving for Tesla as well. What exactly is the conversation like that you've had with your clients and members with regard to what's happened with Tesla?
Tesla did something absolutely remarkable. They took on the entire auto industry and in the early years beat them. But eventually, the electric vehicles are coming on strong by all the other manufacturers. And now you have this incredible instability, almost a death wish by its chairman, who has taken on a political stance that is exactly the opposite of many Tesla holders. The politics don't add up. So all of a sudden in our groups, we're trying to say, how do you balance the fact that you have a CEO that has a political philosophy that's very different than the philosophy that many of the Tesla buyers have, and which is why they want electronic vehicles. So it's a real confusion. Whenever you have confusion at the top, it can't be good for the company.
Okay, so that's the Tesla story there. We mentioned Apple. On the macro side of things, there's no doubt that even at the ultra-wealthy side, interest rates have to be a focus. Not necessarily because a lot of people that are ultra-wealthy buy things on borrowed money, but because you pay attention to these things from a number of different aspects. What exactly is the feeling among your members about where interest rates could be, and is it a pessimistic one?
Yeah. So, when our members start looking for signals of the change in the market, they look at layoffs, bank pullbacks, cap rates rising, and as your prior guest said, consumer debt starting to grow. One of the reasons the markets grew so nicely in the recent years was that the consumer balance sheet was very strong, and now it's going the other way. Our members are real entrepreneurs. Most of our members built great businesses and then sold them. So real estate has always been one of our top areas, obviously very sensitive to interest rates, private equity as well. But there are a lot of opportunities in real estate and a lot of beaten down companies. That's what our members are looking for right now, because with the falling markets, certain opportunities come into light that wouldn't even have been available. So there's a fair amount of measured excitement, but it's sort of a distressed opportunity set where many of our members have made a lot of money over the years.
Okay, so there is the optimism, certain beaten parts of the market, and especially in real estate. That's, by the way, been a trend for wealthy investors and traders for a while, this idea of real estate when it's in distress, going after that. What exactly are they scared of? I mean, what's the thing that they're most fearful of with regard to a maybe prolonged downturn in the market? What exactly could cause that?
Well, obviously, you have this incredible global instability. We don't know how the war in Ukraine is going to unravel. It's already had its impact on energy prices. As an example, if you're in oil and gas, you've had an amazing year. Our members in Texas and Northern Canada had one of the best years ever, whereas some of our members in Silicon Valley have had a really, really tough year. So these changing political trends, real macroeconomic trends really do have an impact. Private equity is now king. That's never happened before. In the 15 years we've been surveying our members, private equity for the first time is 29%, and public equities has fallen to 25%. Most of the fall in the relative share of public equity is just the fall in the markets. But it's a remarkable reversal because for 15 years, real estate was king. But it's interesting, even though real estate today is only 23% of our members' portfolios, when they were asked where they're going to be looking for opportunities next year, 70% of our members said real estate was their number one area, because real estate's not a monolith. You have a lot of interest in certain types of real estate, like workforce housing, industrial, and residential, whereas retail and office would give people really deep concern. But our members are sort of entrepreneurs who've made their wealth rolling up their shirt sleeves, working these assets. And that's why, unusually, the total exposure is over 50% just between private equity and real estate, with a public exposure only half that.